common sense answer is usually the best answer. Avoid the hype. Go into the proven strategies. It's not get rich, especially near retirement. It's not get rich quick. You've probably saved the amount of money that you need to save. It's stay rich, you know?
Retirement isn't the end of the journey. It's where your next chapter begins. Welcome to the Big Money Retirement Podcast.
I'm your host, Johnathan Burgess, owner and founder of Big Money Retirement Solutions, and I'm joined here by Teddy, lead advisor of our Greenville office. And today, I should have said joined by, I guess what do you call it in golf? Your
partner.
Your partner. Joined by my partner. So Teddy and I are not golfers during the week. Okay, everybody, our handicaps are too high. We're better advisors than we are golfers. But Teddy and I do have a good time on the weekends chopping it up, and he's giving me golf lessons. So today we'll make some references to golf. If you're a golfer out there, relate it back to investments and how you need to plan for retirement. So today, a couple of the things I want to talk about. Number one, this guy takes on clients all the time. So wanted to get some of your takeaways from recent client conversations. And also, I do want to say this, before you came on with the team, you were obviously an advisor with
Mutual of Omaha.
Yeah, with Mutual of Omaha. And, kind of did well over there, and then you saw a job listing. Wait, or was it a headhunter that reached out to you?
It was a headhunter.
2.5 years ago?
Yeah. Coming up on 2.5 years.
Which is insane. Because it's so funny, there were two advisors that they had interview with us. One was from Raymond James and the other one was Teddy, obviously. And whenever he came in, I was like, I don't know what it is about this guy. He doesn't have a boatload of experience. Now you have a ton of experience, but he doesn't have a ton of experience, but I really like his vibe and kind of how he shows up. And so anyway, I was only going to hire one. I sent offer letters to both. The other guy made a terrible mistake. He stayed where he was, and Teddy ended up coming over, and for almost the first year you were here, you got Top Gun, and last year you did get Top Gun. So Teddy was our number one advisor last year, so helped the most families. So this guy is a powerhouse, and he is a wealth of knowledge around retirement planning. So excited to have you as a guest today.
Yeah, we're going to have some fun on here too. Chop it up a little bit, run through some different things, and go from there.
Hopefully it looks better than my golf game. So
let's pause there for a second. Your golf game has drastically improved. You've only been at it for a little over a year now.
Yeah.
And you broke 100.
I did break 100.
Legitimately
Yeah.
broke 100. Not just, not...
I did take one mulligan.
It's a breakfast ball. Everyone gets a breakfast ball.
Yeah.
We're not out there. ESPN's not out there following us around the course. We're amateurs.
Yeah, 95. But hey, that's good. So, recently you've onboarded a lot of clients. So I wanted you to talk about a few of the things that you have noticed with people who are coming in right now. What are they most concerned about? What are they asking you questions about what's going on in the world today?
Obviously with the conflict, there's been a lot of volatility in the market. Especially today. What was that? June 5th. Yeah. Today has been super volatile. So really making sure that we're giving them that peace of mind, and the confidence that they can retire. They don't have to worry that they're going to have the income that they want year in, year out to live their life how they want to live it, to live their dream retirement.
Have you ever had to tell somebody they can't retire?
Yeah.
I know I have.
Yeah. And it's, to be honest, it's a difficult discussion, but at the end of the day, it's our job to lead them.
Yeah.
Not just tell them what they want to hear. We tell them what they need to hear.
Mm-hmm. Yeah. I mean, I can recall a few conversations where I would have somebody walk in and they would tell me what they want to take out annually. And just saying, hey, like in a first meeting, hey, I don't know if this is the best idea, but give me a week to go through it and look at it, and really thinking about how I was going to not break the news to them, but basically be like, hey, either you need to work part-time or, and that's for I would say the tendency is most people think they can't retire, but they actually can. I would say
Yeah.
that's probably 90% of the conversations that we have, but 10% of the people that come in are overconfident. And that's where we have to tone it down and honestly bring their confidence level up through at least coaching them on what they need to do to make their retirement last.
Yeah. No, I agree 100%. And like you just said, I would say the majority of the people that walk in, they're scared to death to retire when they don't need to be scared to death to retire. And it's our job to lead them in that direction as well. 'Cause it's a whole lot different for them going to work, knowing they don't have to be there if they don't want to be there. It changes. Everything within their daily routine changes then. They like lighten up, and it's really cool to see. That's where the gratification comes, in my opinion, from doing what we do.
Yeah, and I would say on the opposite side of that coin of, you may have somebody who comes in and they can't retire. I've seen everything from somebody with $100,000 who thinks they can't retire, but in reality they can live on Social Security and just supplement a little bit. And then I have seen people with $9 million come in and be scared to death of investing money in the market and have way too much money in T-bills or whatever it is, and honestly be trying to time the market. I actually had a conversation with a client as I was walking in today, and he's kind of skittish. And he was like, but this guy saved $9 million, but he's scared to death of the market right now. And I think sometimes it takes walking through and just saying, hey, come into the office, let's talk about this. And the thing that I love to do with our analytics software is you can show a client over the last 20, 30 years, if you retire on the worst day, which is actually the day after Christmas in 2007 for a lot of portfolios, because obviously the market crashed in 08. But, if you invest your money on the worst day, as long as you have enough money to live off each month in another safe account, if you hold on to this until it rebounds. I mean, most of our portfolios are borderline. That may be the lowest risk tolerance, may be like 4% through that 6-year period. The highest risk tolerance may be 9 or 10%, even if you got it on the worst day. Well, 10% on $1 million over 6 years. Oh my gosh, you're talking hundreds of thousands. I mean, the first year it's $100,000. It's like, well, it's not in a straight line, obviously, but you have this huge compounding effect after a recession. And I think a lot of what I've been thinking about recently is at some point in our, luckily we had the turmoil that's happened more or less recently with COVID and the interest rate deal, and also the conflict in Iran, the tariff spook back in April of no, that was April this year.
Last year, April 25.
Man, it's crazy how time flies. April of 25. But most of these have been pretty elastic, pretty elastic drops in the market. But at some point, the market will go down, and we will go through a recession. And so I think a lot of, I guess, giving clients that ease is not only building a plan, monitoring that plan, but even through recession, over communicating. Like I'm currently working on a plan where, when the market does go down with our clients, we'll do auditorium sessions for sure. We'll get them together every 2 months. Like, if you think about people it's on us to help people not make mistakes. And how many times have you heard somebody come in and say, oh, in 2008, I lost?
Yeah, countless.
When have you ever lost a share of stock?
Only when you sell it.
Only when you sell. Like, you can't, it's not like your stock drawer. You can't lose a share of stock.
Yeah.
Like, as long as it may go down in value, but you didn't lose the share. It's not like, oh, I misplaced my share. Now with my keys, if Samantha's watching this or listening to this, she's like, oh, Johnathan, you lose your... I need to get one of those Apple AirTags, honestly. Anyway, lose my keys all the time. That's a separate discussion. But you can't lose the stock, okay? It's like so simple. Whenever the market goes down, you have to make sure that you own a high-quality asset, that you have conviction in that asset. I talk to clients a lot, especially current clients. They'll come into a review, and this has happened a lot recently. I mean, when I say we have been killing it, that we've been killing it for people. Like, I mean, I had a couple come in, and I'm not going to say numbers because I'm not supposed to. Our compliance department's watching this. So.
Put it this way, it's been a good past 3 years.
Yeah, it's been a good past 3 years. But anyway, I have a client come in. Their net worth is a significant percentage higher than what it was when they first met me. And like, I'm going into reviews more or less saying now, like, look, you've been with me for 3 years. It's not going to be like this every year. Like, it's been like this the past 3 years. You shouldn't expect this every single year. Like, I'm almost going in and setting expectations. Like, you should not expect any advisor. I know we've made the right choices and we use common sense advice, and it has worked historically. And, there are thousands of finance books that support our investment philosophy. So, it's time tested, but at some point, even good investments can do bad in bad times.
Oh, yeah. Yeah, they can all lose value, especially if they're overvalued to begin with. And that's why the allocation becomes so important. That's why drafting that plan becomes so important. And when we do the plans, we like to show, and correct me if I'm wrong, almost a worst case scenario on purpose.
Yeah.
To give people that peace of mind.
And right now I'm pulling up something on my phone that's going to be relevant, but, I think we take our rates of return and some of them are chopped by 2/3. Some of them are cut by the more conservative, like fixed rates are cut by like 25 or 30%. Which, so we kind of put in, okay, if worse comes to worse, like you're fine.
Yeah.
I also tend to find that conversation, a lot of people, like when they first come in, they get that sense and that feel of, yeah, I am good to go. But honestly, it takes constant communication with clients. Like even today, like I went into a meeting and there was a client who inherited, this is a particular case, but they had a non-qualified annuity. So non-qualified money went into an annuity, and it's about to mature. It was one that I adopted. And so they had it with another advisor. But I was like, hey, we can use it. They're like, oh my gosh, we're going to get killed on taxes. They met with Chris, and then they walk out there like, we forgot to tell Chris about this non-qualified annuity that we have that's maturing. And I was like, you can just do a 1035 exchange. You don't have to pay the taxes on that annuity if you roll it into a different one and rates are good right now on those types of products. So anyway, they thought they were going to have to pay, I don't know, $100,000 and show $100,000 as taxable income. They're all worried about IRMA healthcare limits and all the stuff they're going to get hit by. I was like, that's just a form. Like we can literally move it to a different one. You don't pay any of the taxes. But like that, to me and you, that's something that is so basic. It's like easy solution. We know exactly what to do for a client. And the funny part is this client is from the banking industry. Like she literally worked in banking for years, like 30 years. And she didn't even know that she could do that. So, I think sometimes we underestimate what the general public, how much knowledge they actually have. And that's why I think it's so important to break it down simply. But we were talking about things being overvalued. Another thing that happened with me today, 2 clients called in and they wanted to talk about SpaceX. Have you had anybody else?
Yeah, it's come up in a couple of discussions. Yeah.
Yeah. So first thing, to go pre-IPO, you obviously need to be an accredited investor. But they're set to go public June 12th, and I think this podcast will probably air after.
Yep.
I say all that to say I have no idea what the stock is going to do. Okay, it could, but it could go through the roof.
Disclaimer.
Yeah, disclaimer. I have no idea. But also it has one of the highest valuations of any company that has ever IPO'd. The current valuation is $1.77 trillion.
Yeah, before it becomes public.
Which is, it's just so difficult to, sometimes, like, I think everybody, well, if you don't know this, the markets are driven by fear and greed. Definitely a play like that can be greed.
Mm-hmm.
And less than 1% of your net worth is okay to put into something like that. But the odds that it sticks at a $1.77 trillion valuation, I don't know.
Especially right off the bat.
Yeah.
Right? Not to say it can't build into that. Absolutely. We've seen companies do it over and over and over.
Mm-hmm.
that's high.
Yeah, and the thing is, you would need to get in earlier. Like, I mean,
Yeah.
anytime you hear Warren Buffett always said it. He said when your shoe shiner starts to give you stock advice, that's when you should worry. That's back in the day, whenever on Wall Street they had shoe shiners, but you should be concerned about how the market is currently being valued.
Yeah. Yeah, and it's just with that SpaceX one in particular. Not to say, like you said, if you want to put some of your portfolio, because it is speculative. Right off the bat, it's speculative.
Yeah.
But not to say it can't turn into a proven position, a strong position, like the NVIDIAs of the world, the Apples of the world, Google, Amazon, whatever it be. But at a high valuation like that, before any proven data comes out, that's tough.
Yeah. I mean, I think for the ordinary individual, I say this a lot. We're not necessarily, traders, we're asset allocators. Like, it's more retirement engineering than anything else. Like, how do you allocate all these buckets of money to work together with taxes, with Social Security? But you look at something like, for instance, somebody calling in about SpaceX. Okay. Let's say it's a client. The one client that called in had about $500,000 and they wanted to put in 50,000. I'm like, look, 10% of your net worth, probably not a good idea, Whereas you look at something like, I don't know, I would say, if like one of my clients who's a qualified purchaser, which you have ordinary investor, accredited investor, which is $1 million or higher, and you qualify for certain investments. And there are definitely things that I would say, if SpaceX was like of interest to you, maybe getting in pre-IPO or into a pre-IPO fund may have been, but still it's very speculative.
Yep.
And then you have the next level of investor, which is qualified purchaser. One of the things that I've been looking into as an alternative to that, and I just want to, this is going to be me going down a rabbit hole, but I know some of you enjoy stories. There's companies that allow you to participate in private equity investments that are vetted. And so, like, there's a company that is very well vetted, and they do something called satellite buses. Have I talked to you about this, actually?
A little bit, yeah.
Yeah. So they do satellite buses, and so it's a proven concept. They have revenue. They have the patent for these satellite buses that attach onto the rockets at SpaceX, and then they already have orders coming in for and they can build them the fastest. They're the strongest. They have a 20-year shelf life. And so putting money into something like that has real commercial and defense applications, like that, to me, with government contracts, is a much better play, where you can actually look at the finance, and it's not the entire mass of the world just running at something. Like, smart investors look for opportunities like that. If you're looking for something that's a true alternative, like, that is where you would go to make an outsized return, in my opinion. Because I'm saying this, and I highly doubt anybody listening to this right now knows what I'm talking about, or the company that I'm talking about. And that's the thing. If you're on the back end of, like I said, with the shoe shiner and Warren Buffett, typically all your value's already been squeezed out of the lemon, and you don't want to. And the common sense answer is usually the best answer. Avoid the hype. Go into the proven strategies. It's not get rich, especially near retirement. It's not get rich quick. You've probably saved the amount of money that you need to save. It's stay rich,
Exactly. It's the opposite of get rich quick at that point.
Yeah. And even if you wouldn't consider yourself rich, it's not how much money you make, it's about how much money you keep. I know we tell clients that all the time. Even whenever we talk about taxes, like, you look at some investments and they look very attractive, but at the end of the day, you could be getting hammered in taxes on these vehicles, like mutual funds, right? They're trading all the time. You get hit with a phantom tax.
Exactly.
And I've seen, can I go on a rant for a second?
Hit us with it.
I think so many advisors have alligator arms around doing or creating a retirement plan. You ever seen an alligator try to hug something?
I can picture it in my mind. Yeah.
I mean, it's like, does it have arms? Yes. Are you going to see an alligator like hug something? No, it's just going to bite something's head off. But yeah, most advisors have alligator arms. They're just an advisor. They're not necessarily like a true retirement advisor. And I just think a lot of the things that we talk, like, any me and you and I, we could walk out of here and we could pretend we don't do what we do. And I could say, hey, this is, I'm Johnathan. This is Teddy. We own JT Properties. I don't know. We're interested in investing money with you guys at JP Morgan. They would talk stocks with us. We'd probably sit in there for 3 hours. We could walk into Merrill. We could have that conversation. We could walk into Morgan Stanley, Raymond James, wherever. But to come in and the first conversation is like if we are older, so let's make us both 30 years older. We're walking in, we're mid-60s, 70. You'd be 70.
Not quite.
Yeah.
Almost.
Yeah, you'd be right at 70. Old guy. Anyway, you're right at 70. If we had a client, what would you say if I walked in and said, hey, talk to me about SpaceX, if I met you for the first time?
What are you looking to accomplish with SpaceX? What's your goal?
I just want to make money, Teddy.
Just want to make money, so you want to get into SpaceX.
Yeah. But I mean, eventually I would want to retire, but the purpose of the money is to, I want to grow it.
Okay. Why do you want to grow that money?
Because I have a certain goal that I want to hit for retirement.
Okay. And then we start getting into the goals.
Yeah.
And then so the conversation, it's just framed a little bit differently. It's all about, first and foremost, the client.
Mm-hmm.
But leading them in the right direction to get to that end goal. What is the end goal? How do you achieve that goal with the most peace of mind as possible? And SpaceX might not be that answer, though.
Hey, I might throw some couple bones at it myself. No, I'm not throwing any money at SpaceX. Watch, I'm going to say this is going to be the largest IPO jump in history. It's going to go by 100% the first day. Just as fast as something goes up, guess what?
It can go down.
Just as fast. So, all right, it's Friday, 5:00. I hope wherever you're catching us, well, right now it's Friday, 5:00 because we're recording this. Teddy's got a family, okay? He's got a little girl on the way.
I got one on the way, and I got one at the house.
Yeah. Yep. And so I'm going to let you get back to your family today. But I will let you know how, if I have Teddy on for the next podcast, we'll let you know how our round went this weekend. Like I said, we're not weekday golfers.
No, strictly weekend, which is honestly, I've been playing more than I have been playing, which is awesome.
Yeah, no, I've really enjoyed it. I mean, Emmett, so I have a 2.5-year-old, for those of you that don't know. Every time I get home, like I'll drive home here in about 30 minutes. As soon as I walk in the front door, he will say, golf course, golf course, golf course. And Dad will be throwing on, honestly, a T-shirt, because we live on the golf course. So I'll throw on a T-shirt, some gym shorts, and we'll go out there and we'll play 3 or 4 holes. But that's honestly what's helped me so much. And I want to tell you this, if I can have as bad of a golf game as I had 1 year ago and through repetition break 100, maybe you're watching this or listening to this and you're like, I don't really feel like I know what I need to know about investments. You are in the right place. You're a product of your environment. Continue to soak in this content. Continue to soak in this information. Have a white belt mentality. If you're listening to this right now and you got 10 million, 20 million, having that white belt mentality. I mean, I was just around business owners or other firm owners this weekend, and they were like, you can't learn anything from me. You're way bigger than we are. I was like, man, you can learn something from anybody.
Absolutely.
And you have to have that humble mentality going into it. And that's what creates growth, is that humble mentality. So I want to applaud you for listening to this. We will catch you on episode 37. And Teddy, thanks for joining me, man.
Adios. Been a pleasure.